Hey, welcome to the Victor H Investing live stream. It is Saturday, July 20th, 2024, and we finished the week where stocks traded lower 3 consecutive days. I believe Wednesday was the biggest drop in the NASDAQ that it's seen since 2022. So it was a pretty active week of stocks selling off, especially some big cap stocks. And we're beginning to see a rotation into other size companies, small caps, as well as other sectors. So I wanted to take a look at what's going on in the market and interact with people that attend the live stream, see if we can look at some companies, maybe do a couple of deep dives into a couple of companies. Looks like Shadow Guy is on. How you doing, Shadow Guy? Thanks for joining. I appreciate you joining. And as always, in the comments, please put in stock symbols that you're interested in taking a look at, as well as any other topics that you want to discuss. As I jump into this, let me remind everybody, tomorrow we're going to have our first ever video conference call for the community. And we've got 10 plus investors signed up. So thanks to all those that signed up. It's going to be the first one. So if you want to, how much you want to participate, it's up to you. If you want to be on camera, great. If you want to ask some questions, awesome. If you just want to listen, that'd be great. I put out there a couple questions on the community, and I'm getting some votes on what topics we should cover. If there's something that you think is interesting, feel free to email me or put it in the comments, and we'll look to cover that on the video conference call. That hopefully is going to evolve into something that's interesting for everybody involved, including yours truly. It'd be cool to talk to other investors. I always get a lot out of that. So thanks to everybody who's signed up, everybody who's commented. I appreciate it. So everybody, thanks for joining. Looks like we got best of. Very good to see you again. Chi Wong, very nice to see you. Thanks for joining. Mr. 123 Cheetah, thanks. So the way to participate for tomorrow's live stream, thanks for the question. You email me. Let me put my email address here. You email me and provide your email address so I can add you to the invite list. You'll get an invitation. You'll be able to join the Google Meets session room, and then you'll be good to go. So just email me your email address, and then we'll go from there. All right. Good question. I forgot to put that on there. All right. Perfect. So let's talk a little about the stock market. Thanks everybody for showing up. Look at Halliburton stock. I'd love to. So Halliburton is one of those stocks that I have been looking at for the last, 30 years. And can talk to it, talk about it, and go from there. So thanks for the question. Talmiz 100. All right, cool. And then Ann Kidder. Hey man, good to see you. That's thoughts on CSCO. I believe that's Cisco. Yeah, let's talk about Cisco. I haven't looked at Cisco in a while. I've invested in Cisco from time to time, as far back as, way back. So be happy to talk about Cisco. Okay, so this past week, the market, as mentioned before, and I kind of felt like a broken record. It's great to see periods like beginning in 2022, and you see a rise in the S&P of 53%, and it's even more dramatic on the NASDAQ. Hey, thank you very much, Mr. Market. Thank you very much, Universe, for all that money, because I made really good money in 23, making good money in 24. Appreciate it. But I'm also realistic. And when you have long periods without having a correction, that's when I begin to get a little nervous. If we look at the year, and I'm going to go to the year to date, earlier in the year we had, I think it was like close to 6% correction, and you can't call it a correction until it hits 10%. So we had a 5.46 drop in the S&P, and that was healthy. Now we're seeing about call it a 3% drop in the S&P. Okay, we're taking a little bit of medicine. And what's that medicine look like? The medicine looks like semiconductor stocks beginning to see their prices fall, which should happen because I happen to believe that semiconductor stocks are just priced too high. These are really good companies. I always say this, the stock price is not the company and the company is not the stock price. Those are two different subjects. The subject of these companies like NVIDIA and Broadcom and TSM, these are quality companies. I've owned their stocks. But the stock price is a whole different matter. And in a way, NVIDIA has really just exploded. And it's really hard to get to a valuation that even comes close to their stock price. So I think it's healthy for a market to pull back and see money leave semiconductor as an example and go into small caps, go into other sectors like financials, healthcare. So those events or the transfer of investment dollars from one area to another, that's good. That's really good. We don't want a market that's just one thing and it gets overinflated. So that kind of began to happen. My senses are that in the next 2 weeks, as we look at the big tech earnings coming, next week, Alphabet announces on Tuesday, and Tuesday has some big hitters on it. Then the week following, Microsoft, Apple, Amazon, you got the big heavy hitters coming up in the next 2 weeks. If there's any sign of weakness in these companies, and I'll point to one stock that revealed something, and I did a short on this. Netflix is a stock that I follow, and Netflix announced their earnings. I read their earnings. I looked at their financials. It was a good earnings. They had very good revenue growth. They had subscriber growth of like 34 million subscribers. I'm like, wow, this report looks really good. This company's very good, very healthy. And their stock went down 1.5% in the trading Friday. They announced Thursday after the market closed. That was a surprise. And I don't want to read too much into it, but maybe the market's telling us that, hey, we've priced in a lot, these stock prices like Netflix, right? Over the past year, it's up 44%. Year to date, it's up 35%. Over the last 5 years, if you look at the trough, to the trough being the lowest point that it hit in 22 to where it's at now, in the course of 2 years, it's up 260%. So maybe the market priced a lot of this growth in Netflix, and the stock price represents it. So if they didn't like completely overachieve, the market's like, okay, well, we're not going to buy anymore. In fact, we're going to sell some of the stocks, some of the shares. And that was potentially a tell that the market's saying, tech stocks, communications companies like Netflix, Alphabet, Meta, maybe the stock prices are a little too high. We'll see. TSM had their earnings, and the earnings were fairly good, but market sold off semiconductor. I think a lot of the good growth and good news, so to speak, is baked into these stock prices. The next 2 weeks, we will know if this stock market's going to go down 10, 15%, or if it's just going to say, hey, man, it's going to go up. We might see a little bit of choppiness, a lot of volatility, but we'll see. The other piece that I wanted to point out that told me something, and it was on Wednesday. The NASDAQ dropped more than 2%. Now, when a complete index drops 2%, it catches my attention. There's something there. There's like a big race to the exit on stocks, especially growth stocks. So I'm seeing a couple of signs there that, hey, we may be in for a good correction, maybe 10%, I don't know, 15, I don't know. And I don't know if it's going to stop here and then we're going to go flat or if it's going to go up. Again, I am happy that the market, decided in 2022, in the case of the NASDAQ, that, hey, we are just going to start growing stock prices and go up 71%. It's a little surprising, but as the dollars continue to add up in my portfolio and in my accounts, I'm not going to argue with it. I'm going to take it, but I'm going to be cautious so that way I can manage my portfolio and be wise about it. Okay. So that's what's going on with the markets. Tech earnings are going to be, the next 2 weeks is going to be exciting. I might try to do a live stream midweek. I know I had to do one early this week because of, I've got my business to tend to and other things in life. So I may have to do the same thing this week. And I prefer to do one at 6 a.m. Pacific versus after the market closes, like at 5 p.m. Pacific, because it just doesn't feel as relevant at 5 p.m. in the evening, because I could talk about it and then we have to go to sleep, wake up, and then go trade, as opposed to starting at 6 a.m. and just talk about it. And heck, part of the live stream happens when the market opens. So I thought that was kind of cool. So I'll probably do that like Wednesday, just to check in, see how the market's doing. Because again, Tuesday is going to be a huge day for earnings. Looking forward to it. So if you can join the live stream, and it'd be great to have you. If you're on the West Coast, I apologize. Sorry that maybe you can't make it at 6 a.m. If you can, I appreciate you joining. So, all right. So those are the markets. Now let's get into some of these individual stocks. I'm going to hold off on. Don't worry about your comments that I haven't spoken to. I'm going to get to them. I just want to get to some of the symbols that have been brought up. I'm going to look at those and I'm going to get to your comments. All right. So hang in there. The first one was Halliburton. So Halliburton is, I think it's 1L, Halliburton. Yeah. So I'm very familiar with Halliburton. They're in a mix of businesses. They're in oil, but they also do a lot of services related to like the government. Like I remember when it was wartime, Halliburton was providing a lot of logistics and supplies to the troops. And they have a global business, but I think one of their primary businesses is a lot of the support of the oil industry. The oil fields, supplying the oil fields, supplying the supplies and materials that they need to extract oil. They also have knowledge in that space. So they've been an engineering firm that oil companies rely on. The reason I know of Halliburton is, I worked in an oil company 30 years ago, and I've been an investor in oil companies ever since, because that first employer got me into the stock that employer has. It's Chevron. And ever since then, it kind of was an area of interest for me because I wanted to take that experience and continue to know. And Halliburton has been part of my universe for that duration. Halliburton pays a 2% dividend, which is a little low compared to their industry. Their stock price, wow, look at that. Over the past year, it's down 5%. That's a little bit of a surprise because oil prices are up. And if we look at the 5-year, it's been pretty much going sideways, kind of from, if you invested some money in them in early 2022 to now, you probably are just breaking even. That's interesting. Let's take a look at we're going to look at their revenue, see what's been happening with their revenue, and then see if I could do a quick valuation on Halliburton. So looking at their market cap's $30 billion. One, I think it's interesting is the vice president of the U.S. Under the Bush administration, Dick Cheney, he was the CEO and chairman of Halliburton when he was asked by George Bush to be his vice president. I remember that event. And there was a good movie that some of my favorite actors were in, a recent movie on that particular character. So They're a $30 billion market cap company. Revenue is 23 billion. So this is a big company. PE of 12. I'm liking a PE of 12. Very reasonable PE. Analysts are saying this is a strong buy. It's discounted by 37%. All right. Well, I'm going to do my own calculations, but we're heading the right direction on this one. When we look at their revenue, they've been growing their revenue. And in 2022, it looked great. So why is revenue growing, but their stock isn't doing anything? Interesting. Market might not understand Halliburton, and it might be an opportunity. Let's keep digging here. So they've been profitable. That's good. Earnings. So the share count, let's see, shares outstanding. Share count's pretty much the same. That's good. That could have been a reason why the share price isn't doing anything, is if they issue a lot of shares, your stock price is kind of, if anything, it's going to go down. So that isn't the reason. Free cash flow. So they have free cash flow of, in the last full year, 2.2 billion, 2.27 billion. And they have a good growth rate there. Okay. And then trailing 12 months is 2.5 billion. So if I take 2.5 billion at a 12 PE, I like this industry. So I'd probably say, times 15, that would give us about, call it $42 billion. That would be like my back of the napkin valuation. And that's well below the 30 billion. So Halliburton looks like an undervalued stock that could reward an investor. Let's look at their debt, because debt could be really bad for a company, because if you have a lot of debt, you're going to be making a lot of interest payments and you're just going to be working, it's pretty much like personal life. If you have too much debt, you're working a full-time job just to pay off your debt. Well, businesses are similar, quite more complicated, but the concept's the same. They have too much debt, especially in a high interest rate environment. They're going to be generating revenues just to pay that debt, which is bad. Okay, total debt is $8.8 billion. That is not a lot for Halliburton, because their EBITDA, and I'm going to look at their statistics, and I'm going to compare debt to EBITDA and see what that looks like. 1.86. That's a low debt to EBITDA. Why do I use that factor? So EBITDA is earnings before interest, taxes, and depreciation. It's another form of looking at like what's useful to pay off debt. You can use free cash, but you can use EBITDA, which is generally what most people do. And that what this means is in less than 2 years, using their EBITDA, operating their business, they can pay off all their debt. So that's a sign of a healthy balance sheet if it's below 3. If it's above 3, let's say it was 6 or 7, that's too much. That's a big debt load, and you're making big interest payments, and you don't have a lot of money left over to grow the business, to pay dividends, to buy back shares, and so forth. So the balance sheet looks good. This business is looking pretty good. I'm going to jump into let's do a full valuation of this guy and see where that takes us. So I'm going to leave the data here. I'm going to open up my spreadsheet, and I'm going to go to Chevron, because that's the most like company that I think of when I think of Halliburton. So here's Chevron, which is a business that I own. I'm going to use this as a copy, and then we'll create the Halliburton one. All right, so this is Halliburton. I'm going to work as fast as I can, so I'm not going to talk a lot. Hang in there with me. So Halliburton discount rate. What kind of discount rate are we going to use in Halliburton? Now, they're not a big giant company. They have a good balance sheet. So we're not going to use a very high discount rate, but I'm not going to give them an 8. I'm going to go with 8.5, because they do have a good balance sheet. They've been around for a long time. They are in a cyclical industry, so I'm going to 9. So the more consistent a business is, the higher the quality of the balance sheet, the better their growth. Let's say an Apple. Apple has a very good balance sheet and a very low borrowing rate. They would have like a 7.5, maybe a 7 discount rate. Halliburton's a quality company, but they're not Apple quality. So I want to go with 9. So we said that they're, and let me make this guy a little smaller so we can see both things. And I apologize if you can't see this. I'll make it bigger once we're done with the analysis so you could catch up. But for now, let me try to fit these guys into one screen. Okay, so we said for free cash flow, I'm going to use the trailing 12 months. This is this column here of free cash flow. And free cash flow for the trailing 12 months is $2,585 million. So it's 2,585 is here. That's a trailing 12 months. Now the growth rate, I believe that the oil business is beginning to grow because oil prices are nice and high. They're not super high, but they're nice and high. If Trump gets elected, which I believe the chances of him being elected have really gone up, Republicans tend to be very good for oil businesses. So I expect that oil businesses are going to do better. We're probably going to explore more. So I'm actually going to grow their free cash flows by 8% in the near term, which is years 2, 3, 4. That's going to grow our cash flows. This is our cash flow forecast. And then after year 4, terminal value is all the cash flows after year 4. And that's a big giant formula. Google it if you don't get what terminal value is. It's a really important term to know. So I encourage you to look into that and get to know what terminal value means. So let's look at their balance sheet to see how much cash they have. They have right now $1,879,000,000. Wait, got that wrong. 1,891,000,000. All right. How much debt? I think we were at in the 5s, and total debt 8,787. So this is what I call equity value. And that's when I take the present value of all the cash flows I expect Halliburton's going to produce. I'm going to add the cash because that's cash on the balance sheet. And I'm going to take away the debt. If I wanted to, in simplest terms, buy this business outright, I'd have to pay the debt off to feel like I own the business outright. And the equity value will be $46.4 billion. And the current market cap of the business is $30,450,000,000. So let's put that in here. We have shares outstanding, 885 million shares outstanding. So as we look at Halliburton, the stock price is not $154, it's $34.40. It provides a 53% discount if we value this company using free cash flows and then determining what the per share price of that company is using free cash flows. Free cash flows is Warren Buffett's favorite technique. Charlie Munger, the late, great Charlie Munger, he used free cash flow. Free cash flow is used by most investors to determine if that business is valuable. The other way of looking at it is look at the top most valuable companies, Microsoft, Apple. Look at their free cash flows. They are excellent free cash flow generating companies, and that's why they're worth so much money. So we looked at free cash flows. It's discounted by 53%. Now let's look at earnings per share, because I like to look at both, because sometimes a business is young and they are not quite producing a lot of free cash flow, but they're growing really fast and the earnings per share is growing really fast. So I like to include that in my analysis. So 2024, it's expected the company is going to do $3.42 of earnings per share. I'm going to go with an 18 because I like Halliburton. I like the oil industry right now. A lot of things are looking good for the oil business. For example, if Republicans get elected, which chances are that's going to happen. That's going to be good for the oil business. There's probably going to be more activity, and Halliburton's going to benefit from it. Growth rate, they're supposed to grow their earnings per share much faster if you look at this line here. So I'm going to go with, let's say, an 8 there. I try to be conservative. I've never used, like, if analysts are saying 16, I'm like, well, it's my money that I'm investing, so I'm going to go with 8. But even when we kind of calm the growth rate down, my PE is 18 because I understand this industry. I know the value of Halliburton. There's some good things brewing. It really has a nice discount of 93%. I take both techniques, but I put more weight in free cash flow method. It's 2/3, 0.6, and then 1/3 earnings per share. And it's a 66% discount on Halliburton. That's a really nice discount on a quality business. I've heard of this business. I'm glad I analyzed this, and this is going to be on my watch list. And I'm going to look to potentially invest in this company at the right times. Now, I don't make an investment this quickly where I'm like, oh, look, it looks good, I'm going to jump in. I'm going to probably study it a little bit more. I am familiar with Halliburton, as mentioned. I've been following the oil complex for 30 years. So I'm liking this company. And who suggested it? Nice suggestion. Thank you. I think it was Talmiz 100. Thank you, sir. Let's take a look at another one. Cisco. All right. So let's take a look at Cisco. So Cisco Systems is the leader in networking equipment. They were the pioneer way back in the 90s. They pretty much built the internet. Awesome company. Something that's interesting, but not the favorite thing to review when you look at Cisco is their stock went parabolic way back in the day. And because everybody thought, man, these guys are going to be worth more than all the other companies in the market. And then it collapsed, not because the business was bad, but because the stock price got too high. And ever since then, it's been kind of going up, which is good. Over the last 5 years, the stock hasn't done all that great. Look at that. That's not good. And when you look at the yearly, man, it's down 9.6%. This is a quality business. This is the leader still in networking. So it's interesting that it's there. All right. So Cisco pays a 3.38% dividend. That's pretty good. That's fine. Okay. Let's take a look at their fundamentals. So when we look at Cisco, it's a $190 million market cap. Revenue is $55 billion. Okay. PE is reasonable at 16 for a tech company. We'll see if they're growing. That'll be important. This is a buy-rated stock by analysts, and they're saying it's 18% discounted. All right, good so far. Let's take a look at their growth. They've been growing, not so much in the trailing 12 months, but that's pretty good growth, especially in 23, growing more than 10% when you're the size of Cisco. That's a very good number. Let's look at their quarterly really quick. So this is maybe where there's a little bit of concern is you can see that I'm looking at the quarterly, and we had really good run of quarters from 22 up till 2023. But it looks like the most previous quarter, they had kind of a pretty good drop of 12%. All right. Not a showstopper for me. I'm happy to buy quality businesses like Cisco at a discount when they're having a couple bad quarters or a bad period. I'm cool buying great companies at a discount. But let's see if this company is worthy of our investment dollars or my investment dollars, because I worked really hard and have been, working at this for a while. I am not going to just, invest in something that's bad. So revenue is, let's go back to the annual, $56 billion. All right. So I first want to look at their free cash flows. And what I try to do is, my train of thought is do a quick swag. And if I think like we just did Halliburton and I did the quick swag and I'm like, that's probably going to reveal a pretty good discount. Let me keep investing my time and your time. We're going to do the same thing here. We're going to do a quick swag and see what we think we're going to end up with. So free cash flow, $19 billion. Man, that's a nice number. Why the heck's the market discounting this company so much? The trailing 12 months is 12.4, so we'll use that. Now, Cisco is a quality business. I mean, I could go 20 times that because it's a quality business. There's only one Cisco on earth. There's probably some challengers against Cisco, but man, they're a pretty good company. So if I multiply this times 20, I'd get to about, call it 248 billion dollars of value. Just a quick swag, and their market cap's 190. So you're getting the quick swag calculus is you're getting like a 25% discount on this stock. So that is a stock that I'm interested in kind of doing a deep dive on this one too. So let's go through it really quickly, and we'll see. Before I do that, let me look at their balance sheet really quick, because that could be a showstopper. If they have a ton of debt, I'm going to be like, yeah, I'll pass. But total debt, 32. What the heck happened here? So they went, am I looking at the quarterly? Annual, good. So total debt went from 8.3 billion to 32 billion. The reason I had to double check it is you don't typically see that, but there it is. So 32 billion. Now that might not be all that bad. Statistically, let's look at debt to EBITDA. Debt to EBITDA is less than 2. So we're cool. Yeah. Because a company this big having that debt, they can pay off all their debt just operating the business in less than 2 years. So I'm good to go. All right. So let's do a quick Cisco analysis. Cisco's probably going to be less impressive than Halliburton, but let's take a look at it. So I'm going to pair up Cisco with HPQ. HPQ is Hewlett Packard. They're more of a consumer-like business, but I'm going to go ahead and use them because I like the structure of that valuation. All right, what's going on? Okay, so let me try this. All right, computer like this one better. All right, so let's take a look at Cisco, and I'm going to go as fast as I can. That way we can cover as much ground as we can here. So this is Cisco. We are looking at so I use a discount rate of 9% on HPQ because it's a little bit risky, PC sales, and that's what HPQ does primarily. Cisco is a good company. I think a 9% discount rate applies. So let's stick with that. Now, what was the free cash flow that we went with Cisco? Let's see here. So financials, cash flow. So free cash flow. So the trailing 12 months is 12.4 billion. Let's go with that. That'll be 12.4. I'm going to update this so that I know that I'm using trailing 12 months. All right. So we have trailing 12 months, and now their business is going to expand anytime soon. Big infrastructure for internet. Obviously, we need internet because we're on the internet right now. 6% is decent. I'm going to go with 6%. I'm going to keep the 6% consistent. And the reason I used HPQ is now you're seeing that, hey, as PC sales grow, probably the internet's growing. So I'm using same factors for same industry type. And so I'm going to go 6% on growth for the short term, 4% over the long haul. And when I do that, the forecast for free cash flows is right here. The first 4 years will forecast here. Terminal value 307. And that's much larger than Halliburton because this starting number is much larger. So we get to 243. Remember how my swag kind of got us in that range. All right, so now we're looking at cash. Let's take a look at some cash. Cash is 22.2 billion. Man, that's a nice number. Go Cisco. And then they have total debt 31.93. So they could almost pay most of their debt, right, with their cash. Now they got their cash. They can probably acquire businesses and so forth in the short term. So you could really see a quality balance sheet. Quality balance sheet usually is consistent with a quality business because they've made money. They can pay off their debts and so forth. So we're at 196.40 for the market cap. They have 4 billion shares outstanding. So it gives us a share price of 57. The current share price is 47.32. 22% discount. If we look at their free cash flows, do a forecast, and then look at that forecasted value of those cash flows in the net present value using 9% as a discount rate, we get to a 22% discount on a quality business. Now let's look at their earnings per share. The earnings per share are expected to be $3.78. $3.78. I'm going to use a 24 because I like Cisco. And there's another thing that I'll quickly cover, which is, why I'm making these decisions, because investing is not all science. It's not just math. It is art, where you have to use your experience in an industry and say, I believe they deserve a 24 based on my criteria. It's my money I'm investing. So I'm going with the 24 because I think Cisco's quality business. They are a leader in their market space. They're kind of in that toward the green of that nice quadrant that I like to use. And that's why I go with the 24. Now, it's not exaggerated. Like 24 is in today's market kind of average. Might be a little high, but it's kind of average. I kind of talked myself into going to 22. Growth rate of 4%. So let's take a look at their growth rate. It's expected the earnings per share is actually going to fall. So yeah, we'll go with like 3% there, kind of tone it down a bit. But even with that, the earnings per share is really, really unappreciated. So the stock's being discounted by a little amount. Now, what is concerning me around Cisco, so it is a discounted stock. What's concerning me a little bit is if we looked at their financials, what's going on with this quarterly? What's this trend all about? Like, what's going on? Like, how do you lose 12% of your revenue, right? So if I would be looking into what are the reasons behind that? Does it make business sense? Is there anything broke with the business? What's going on? I don't think it is. I think they're just probably dealing with some, they sold a lot, a couple quarters ago, and customers are like, hey, I don't need to buy any more networking equipment for a while. But Cisco looks like a good business. I'm going to put that on my watch list. So two businesses that are well known and, that value quite well. Thanks for the suggestion, and Kidder. All right, let me catch up some comments. So Mr. 123 Cheetah, you own both HAL and Cisco. All right. Good deal, man. I think both look pretty good to me. I don't own either one, but I'm going to put them on my watch list and keep an eye on them. Shadow Guy. Looking forward to tomorrow. Me too. And tomorrow, what'll be a little different is, I'm doing all this like analysis and stuff. And right now I interact with your comments on the chat, but tomorrow we can talk like, hey, let's talk about discount rate. Let's talk about this. Let's talk about that. So that'll be interesting. Hopefully it goes off really well. And I really appreciate everybody who signed up for it. Which investment books do you like? Hey, that's a good question. And I'm going to give you two things. One, I love Spotify. I'm like a Spotify guy. I used to be a Pandora guy, but Spotify changed who I used. And I'm referring to a little journal. So I go old school. You know why? Because I might be hanging out with one of my kids or stuff, and I might have an idea, and I like having a journal around where I can write it down. And I oftentimes write down books that I would like to read. I'm currently in the middle of a book written by Robert Schiller, which is Irrational Exuberance. And that's a book that I like because I think it fits the time. Irrational Exuberance was written around the dot-com bubble. This is a Harvard professor, Robert Schiller. If you hear online the Case Shiller report on real estate, that's the Schiller. The dude's Harvard, very respected guy. And he looks at kind of like when the markets get carried away to the upside, what are you seeing and what's the behavior? So it's really interesting. The book that I finished that I really liked was Pat Dorsey, Five Rules of Investing. Quality book. Those are the two I'll put out there. Thanks for the question. All right, next one. Just saw your intrinsic on Solve. I know what you think is overvalued. Also, if you want to check out ACGL, Arch Capital, would you be cool to know if you think of that stock? Yeah. So I think we want to talk about Solve, and then we'll talk about ACGL. So, so on Solve is for Solventum, and Solventum is a spinoff of 3M. And Solventum focuses on a lot of healthcare products. Like when you go to the dentist, they have a lot of materials, to help patients with their teeth and so forth. A lot of those materials, Solventum, which was once part of 3M, they produce those products for dentists. They also do a lot of medical products. So hospitals and so forth are using a lot of the products that Solventum is producing. It was a spinoff from 3M. I think structurally, a lot of spinoffs work, by the way. Some spinoffs don't work, but a lot of them do work. A very famous one is PayPal. PayPal got spun off of eBay, then ended up being a gigantic valuation, which was a real success story. I value Solventum, but they've been around, as a standalone company. They haven't been around that long. And all these numbers are somewhat extrapolated from the financials of 3M. So when I look at Solventum, I'm not ready to invest. And I actually was granted shares because I'm a 3M stockholder. And the reason for it is there's just not enough data to know what's this business worth. Everything that I got from the company, which they did a nice job, is they put like an investor package and said, hey, this is what we think we're going to produce from a free cash flow perspective. But if you look at their actual free cash flow, and I hopefully can get some data in here. Yeah. So when I look at their actual free cash flow, like for this quarter, it was roughly 340 million. It doesn't align with the cash flow that the management team is guiding towards. And there's just not a lot of data. You see how I only get one quarter. So I don't have enough details on the company for me to be an investor. I think structurally it makes sense spinning off Solventum, and they can kind of do their own thing and really focus on the market that they do business in. I'm cool with that. I just don't have enough data to be an investor. So I have it on my watch list and I'm like tracking it, but it might be a year, maybe two before I invest in this company because I don't have enough data. So that's my comment on Solventum. I don't know what you guys think. If we look at like analysts, let's take a look at analysts. 4 analysts cover it. That's not a lot, but that's a couple. And then we have, what's their stock price? $54. So they're from $69 per share to $48 per share. I mean, they're in that ballpark. But all these numbers, right? When you have such a young business, they're guiding for these numbers. And we don't know if these numbers are going to be real. I'm sure they're going to be somewhat accurate, but are they going to be accurate like 20%, give or take? So right now, I'm like, okay, I think it's a pretty good idea. I have a lot of respect for 3M. But I'm going to hold off for maybe a year or two before I really dig into this one because it's too early and I don't have enough data. So thanks for asking on Solventum. So ACGL. So Arch Capital, never heard of these guys. Take a look. So Arch Capital, together with its subs, provides insurance, reinsurance. Okay. So an insurance company, diversified. Okay. Insurance has been really working. I own Allstate. I've done really well. I had Prudential. I did really well. I sold out of that position at a really big gain. These guys are a $36 billion company, market cap, and they do about $14.4 billion in revenue. Analysts say it's a buy, but not heavily discounted, 8.7. Maybe because the stock price is up. Yep, stock price is up 18%, 28% year to date. That's doing real good. Nice. So when we look at their financials, look at their income statement, look at that growth. Nice. Very nicely done. Nice business, nice healthy business. We look at their free cash flow. Cash flow has been growing. Again, remember that earlier statement I made is you get very confident in a business that's going, okay, we're going to grow our cash flow from 1 billion, 1.5, 2, 2.8, 3.3, 3. That is nice. That's nicely done. Nicely done. So that's looking good. So if we look at 6.3, multiply that times 20, we get to like 126. So this is heavily discounted. If they can keep growing, this stock's looking good. I wonder why there's a tiny discount by these analysts. So it's covered by 13 analysts. All right. Their earnings per share is 8.73. It came down from last year, no biggie. And it's supposed to grow at 4% and then 4%. Okay. Still at 8.73. So this stock here looks really good. What am I not seeing that would be freaking an investor out? Okay, so their balance sheet should be okay. So balance sheets for insurance companies are different than like we just saw Cisco, and before that we saw Halliburton. Those are like traditional businesses. Their balance sheets look the same. But sometimes insurance companies carry more debt and they carry liability lines for what they expect they're going to have to pay on policies. So you have to be aware of that. But these guys here, total debt, no, they don't have a whole lot of debt. This business looks really good. So what do you think of the business? Who asked about this? Sayon Ken. So I think there's a lot there. Arch Capital. What do you think? Love to get your feedback on that. Let me move on. Then I'm going to look for your comment on that. All right. So Mr. Market, any thoughts on, so we looked at CELH. I can't remember the name of the company, but we'll look at them again. And then you got another comment, sold some CSP. Not sure it's done selling. So interesting. Take a quick peek at CSP. All right, so let's look at those, and then we'll go from there. So CELH, Celsius. This is the beverage company, right? Yeah. These guys have been a growing. Yeah, they're in the energy, beverage space. And they're going up against Monster, Red Bull. It's a pretty interesting space, right? Everybody, I drink good old, caffeine from coffee. But I know that Celsius and Red Bull and Monster, man, those guys are cleaning up. They sell a lot of beverages. So these guys, I think, are a high growth company. I've looked at these guys before. They're a $11.5 billion business, not too big. You're paying about 10 times, their revenue for the business, which is a little high for a beverage company, right? If you look at Coca-Cola, it's probably going to be like you paid 2 times, revenue for the business, but Coca-Cola is not growing like these guys. When you look at their growth rate, holy smokes, man. People are really getting caffeinated out there. Man, look at that growth. That is beautiful. That's extreme growth. Nicely done, Celsius. So this is an extreme high growth company. When we look at cash flow, are they cash flowing yet? So free cash flow, yeah, they are cash flowing. So trailing 12 months, 270. Wow, man. That's incredible. So let me write that down. So 270 million in trailing 12 months. Okay, so the cash flows, extreme high growth. Do they have a bunch of debt? Not a lot of long-term debt. Total debt, no debt. Man, Celsius is looking good. What's your stock been doing? What's happening here? Why are they down so much? Were they part of the CrowdStrike outage? Did they have something to do with it? Were CrowdStrike employees drinking Celsius when they wrote that bad code? That's a bad joke. All right, so what's been going on with their business? What's going on here? So from here to here, we're down 48%. What was the news that drove the stock down? Why is the stock down? And that has to be answered, right? In order to make a wise investment. But let's take a look at their financials again. So income statement, let's look at the quarterly. So the growth rate is slowing down in the most recent quarter. It came down to 36% from a 95, 104, 111. I mean, those rates are blistering, which is awesome. Now, is this the beginning of a trend that changes that growth rate? I don't know. But let's go ahead and value this company and see where we get. Just back of the napkin, 270. This is a high growth company. So I'm going to multiply that. You know how I was using 20? I'm going to multiply that times like 40 because it's a high growth company. And this is, I just want to get within the ballpark. And I get to just a little bit north of $1 billion. So I'm not getting close to their current market cap. So on this one here, this is worth looking into because this drop could be a big opportunity if this company can keep growing. And I don't know enough about the situation to make an accurate call on what growth rate am I going to use, because the growth rate that you use on a valuation like this is going to dictate what your estimated, stock valuation is. So I'm not going to dig into this one because I want to go do some homework on what happened, what's the story. And then based on my homework, I would say, okay, I'm going to expect they're going to grow at 20%, or they're going to grow at 10% or 50%, because that decision is going to drive the valuation. And I can dig into the numbers like we did on those other stocks, but I think I'm not there yet. I need to understand the story first. I'm glad you brought it up because it's super interesting, and you gave me a homework item to look into. Let me make a quick note. I'm going to look into Celsius, and I might create a video over this one because this is an interesting situation. It's got a pretty interesting plot. Like, it's really crashed down, and it's done it before. So, man, interesting. All right, cool. Moving on to CSP. And I think this is a stock you sold, right? So CSP develops and markets IT integration solutions. Okay. So they are in the technology software space, tiny, but their revenue is 62 million. They have a tiny dividend. PE is 26. Okay. And maybe you can comment, what were the reasons why you sold, and what forms the opinion that it could continue to sell? That'd be interesting to find out from you if you can comment on that. All right. And Kidder, S-Bucks jumped 6% on Friday. Yeah, I saw that. Activist Elliott built a stake. Yeah, potentially. Yeah. So your second comment, wonder if an activist will do the same with Nike. I don't know that Nike's broken. I think Starbucks, the management team might need some changes. I would definitely be open to that, because they didn't hit a home run coming into, taking over Starbucks. I think the Starbucks business is really good. I think, and I did a video on Starbucks. You can watch that, and I've covered Starbucks on other live streams. So I really like the business, and I like, out of one of these books that I just recommended, I think both books, they will both say that you can find a very valuable business. The management team is almost not a factor. Example, you take Alphabet, and I think their management team's excellent. So it's just making a point. and you switch the management team, you still have Google search. You still have YouTube. Okay. You still have their Google Cloud business. You still have a pipeline of awesome ideas like Waymo and AI and all that good stuff. But you can't switch a business very easily. So when you look at the Starbucks business, you're getting the leader in premium coffee with an established brand globally, with franchises, or not franchises, locations around the world, especially in the US. It's a big cash flow generating company. So there's a lot of good stuff there. So Nike is a very valuable business. I did a video on Nike. I've done two, and I'm very bullish on Nike. I think their management team there is toning down expectations, which is, somewhat understandable. I'm going to give them benefit of the doubt. The Nike business is solid. There's nothing wrong with the Nike business. I think they sold so many darn shoes, especially in 2021 when everybody had their stimulus checks and were like, hey, I'm going to go buy a new pair of Air Jordans for $300. Yeah, that's what people were doing in 2021 with their stimulus checks. And now there's no more stimulus checks. So I think we're having to deal with that. So thanks for bringing up Starbucks. Shaquille K, Netflix. Be happy to talk about Netflix. I talked about Netflix earlier in the live stream, but I didn't really analyze it a whole lot. So Netflix, I believe, is a stock that I already have analyzed. So let's see if we can jump there. So Netflix had a very good earnings, and the stock market said, yeah, that's fine, but we don't care. We're actually going to sell off your stock. And it went down 1.5%. Here's my valuation in Netflix. And Netflix may be a little higher than this. Let me catch up to the stock price to make sure I'm giving you the most current numbers. So okay, so the current stock price is $633.34. So based on the most current stock price, and I updated this on the 18th, right after their earnings. So I still think that Netflix is overpriced, being priced at a premium of 13%. Now, I don't own Netflix. I've made good money on Netflix. And the reason for it is that Mr. Market is a strange, entity at some points. It sold off Netflix by 74%, and I bought around this range. And I made great money on Netflix, and I sold around this range. And I said, thank you, Mr. Market, for that money. I appreciate it. I bought like 50 grand of it. Thank you very much. Took the gain because I believe that Netflix is a one-trick pony. And here's my point. Netflix has to compete with YouTube. And YouTube is part of a bigger business that has Google Search, Google Cloud platform, which is an infrastructure play, and soon to be Waymo, self-driving, AI, all that good stuff. So Alphabet can really help YouTube grow. And maybe if it has a bad year, the rest of the business can kind of support it. Disney has Disney Plus, and they have all these other businesses to support that particular area of the business. Netflix just has streaming, and they have to produce a lot of their own content. And it's really become expensive for the company. And that's why my valuation isn't, skyrocketing, up. And I also feel that strategically, they're a little bit vulnerable against the competition they have. Disney, Apple's another competitor, and Apple has a more diversified business. I just talked about, Alphabet. You have Comcast with their, Peacock streaming service. So you have some pretty strong competitors, and these guys are a one-trick pony. So I love the company. I mean, if the market were to discount it again like it did in 2022, I would buy it right away. But right now, I am staying away from Netflix. So thanks for the question. As always, guys, I never provide any financial advice. Everything I say is just what I'm doing. Do your own research, make your own decisions, and always keep that in mind. All right, the family guy. Good afternoon, Victor. Thoughts on Shopify? Yeah, I haven't talked about Shopify in a while. Those guys at one point were like screaming up in value. Let's take a look. Now, I have not been all that impressed with Shopify recently, but let's take a look. So Shopify is a $81 billion company. I think if we look at the 5-year, you'd see, whoa, their stock price was at 169. Now we're at 63. So it most definitely took a roller coaster ride, right? We look at the high, which was in 21, to the low, it went down 84.5%. Holy smokes. But from that point to now, 62%. Looking at the 1 year, they're down 3%. And if we look at the year to date, they're down 14%. Now, Shopify is a growing business. It's they do things in a very good way where customers and businesses really appreciate them. And I think that it's one of those, what they do it the best. When we look at their valuation, analysts are saying it's a buy and it's discounted by 20%. They have a forward P of 59. I don't think they're profitable yet. So that's why there's no current PE. So they're about to be profitable. When we look at their income statement, I'm going to look at the quarterly. That's very good. So 23, 24, 30. As they get bigger, it gets harder to have that big growth rate, but that's still very good. So annual, they're a $7 billion revenue company growing at 25%. So that's good growth rate. When we look at their free cash flow, so the cash flow, man, that's good cash flow. So this one here is probably going to value, I mean, the best that I can get to, and I'm looking at 1 billion, right? 1 billion trailing 12 months. If you multiply that times 50, I get to 50 billion. And their market cap's 80 billion, right? There's no way I can get close to that market cap. I'd have to do a lot of homework on how are they going to grow? Like what's that big secular trend that I expect is going to carry this company for the next 5-10 years? Secular trend would be like when Amazon 20 years ago was seen that e-commerce and really the internet usage was growing at 2,000%. E-commerce was growing at 2,000. That's a secular trend. Now Shopify is in e-commerce, but what they're trying to do is give their customer, which is a business or a small business, maybe a better look online so they can sell more stuff. It's a better solution to something that already exists already. So I don't think I'm going to get to an $81 billion valuation on Shopify. I've never have. They're always like, this is a growth story, and there's other investors other than myself. I always want to be on, run a valuation that supports the stock price, gives me a discount, and then I invest. Shopify is not one of those companies that's ever come into a valuation that reveals a discount or where I can make sense of their growth and then invest in the company. So thanks for your question. Cisco bought Splunk. Okay. Now that might be a really good investment for them. Splunk, I believe, what does Splunk do? I know they're a technology company. So so they do cybersecurity. All right, cool. Okay, cool. Well, that's a very good place to be. The only place you don't want to be in cybersecurity is at CrowdStrike. So that's another reason why I would like Cisco. So that's a double little star next to Cisco. Thanks for revealing that. That's good stuff. Yeah, it looks like Yeah, that's an interesting story now. That was a very timely acquisition by Cisco because I think all the other cybersecurity companies have gone up in value other than CrowdStrike. Because CrowdStrike, I mean, that was a horrible thing, man. The biggest outage in history is now going to be the part of the brand for CrowdStrike. Yeah, cool. Yeah, rational investing. That's a good one. Please look at this ETF. Onshoring from Mexico is super hot. So Max, let's take a look at Max. I agree with that. I own one company down, I should say, that does business in Mexico, and that's TXX. So this is Mexico Bulls return share. Okay. So I don't quite understand what this is, but I understand the concept. I agree. Onshoring is going to be really hot with Mexico. This here, they have an okay dividend rate. We look at the 5 year. Okay, it's come down recently. I wonder why. I'd want to understand what are these holdings. Like, I'm not sure what these are, so I'd have to investigate those and see if it's something that I would buy. The two investments that I own in Mexico, first, I own TX, which I would say 65% of their operations are in Mexico, in northern Mexico, and they produce rolled steel that first they supply manufacturers that then create products that end up in the US, or they sell their rolled steel into US production plants for them to create products. Good investment. It's been doing really well and it pays a good dividend. And the other thing I did is I bought about $50,000 in bonds with their national oil company. They don't have a publicly traded oil company, but it's called Pemex. And I've been doing about 11, 12% a year return on that. That's really good from a bond. So I agree with you that the nearshoring, especially, I'm expecting that the Republicans are going to win the presidential race. The last time Trump was a president, his favorite enemy was China. And if that's going to be the case again, he's going to put a lot of stress on that, economic relationship, and it's going to give Mexico again an advantage to produce products that the U.S. needs. So, good stuff, man. I'm glad you're thinking along those lines. I'll take a closer look at this Max. I'm not a big ETF guy, mutual fund guy. That how we all have a few regrets, and the one regret I'll share with you is when I was a youngster 30 years ago. I did read online. I tried to keep current on things, and I probably followed a lot of advice that what a lot of advice was good, but a lot of advice was bad. Part of the advice that I probably took that was wrong was I was too much invested in mutual funds, and we didn't have ETFs back then. And I would actually, I could have gone further if I would have got into individual stocks sooner. That was one of my regrets. So that's why I don't touch ETFs a whole lot unless they make a lot of sense. I own a couple, but they're kind of specific. And I think if I would have gotten into stocks, when I was 24, I would have kind of climbed the learning curve faster, and I would have probably made a lot more money. I did fine, but I would have made a lot more money sooner if I would have gotten the grasp of stocks that much faster. So that's why I stay away from ETFs and mutual funds, is I think I can make more money, and I don't like paying fees on some high price ETFs. All right, so let's keep moving. Gabriel. Hello, Vic. Hello from Phoenix. Yeah, I talked about CrowdStrike quickly. I guess I could talk about it again. And I know one Gabriel in Arizona, but you're in Phoenix, and the other Gabriel that I know is in Tucson. So I don't think we know each other personally, right? So, yeah. So you want to know if it's a good buying opportunity. Now, I just recorded a full video on CrowdStrike. I have a full video on CrowdStrike on my YouTube channel. And my conclusion on that CrowdStrike video is that as of June 4th, 2024, I thought the stock price was overpriced by 35%. And here's the video. I'm not going to play it here. Hopefully it doesn't play. And I concluded a month and a half ago, the stock was overpriced by 35%. Now you have this screw up. I mean, this is a huge screw up this week. And I did a revaluation of it. And I think now they're overpriced by 37%. So they have a lot of explaining to do. And they're overpriced by 37%. Here's their valuation. Okay. So needless to say, I am not buying CrowdStrike. I'm actually taking a short position on CrowdStrike. I started a short position on them 2 weeks ago, and I'm up 19% on my short position on CrowdStrike. So not sure I would. So for me, I'm not buying CrowdStrike. I'm actually shorting the stock. I'm glad I shorted it. They screwed up big time. I think having the simple explanation of what happened, I'm not buying it. You don't bring down hundreds of millions of PCs around the world and say, oh yeah, there was a bug in the code that we had on a release. Okay, well, if that's the case, CEO CrowdStrike, how is it that a simple issue like that could get through your quality control and make it to market and take down hundreds of millions of PCs? I think your customers are going to sue you like you wouldn't believe, because that's negligence. So they're either going to get sued big, or there's a bigger issue, or both behind the scenes that, hey, maybe they don't know what happened. Maybe it's more complicated, and they couldn't explain it to the average person, and they went to the media with a simple explanation. Long and the short of it is that's my position on CrowdStrike. Hopefully you found it interesting. Again, not financial advice, just sharing with you how I see the situation around CrowdStrike. And the video on CrowdStrike should be out tomorrow. If you want to watch the most current one, if you want to watch my analysis that I did on June 4th, it's already on my channel. Shadow Guy. Yeah. I just shorted CrowdStrike. Yep. But I shorted them about 2 weeks ago. So I think yesterday morning is when the stock went down so much. So yesterday morning, I woke up before I had my cup of coffee. My son, he's 19. He goes, hey, CrowdStrike is down 20%. I'm surprised it was only down 11%. You look at like how bad the outage was, and I scratch my head and go, their competitors are going to have such a useful fact against CrowdStrike now, right? When you look at Palo Alto Networks, or we looked at Cisco just acquired, forgot the name of the company. All their competitors are like licking their chops going, where is CrowdStrike installed in this particular territory? Because I want to go talk to those customers and see how bad it was for them and see if they want to look at our products. I know that's going to happen. And once you affect their growth rate, CrowdStrike's growth rate, what do you have? You have a business that is okay, but not worth $80 billion, or actually 75. They were worth 80 billion before. Now they're worth 75 billion. This could be quickly. I mean, you look at like Shopify, right? Shopify, when they were on this growth trend where they had super duper growth, this is the valuation. As soon as the super duper growth stopped, this is the valuation. This could be CrowdStrike's chart in a year or two. If their growth stops, they're going to drop. They're going to drop fast. like Shopify or any other company that stops growing, because Shopify's valuation is really based on, you better keep growing at 25 to 30%. If you start growing at 5 to 10%, you're toast. You just lost half your valuation. My opinion, not financial advice. All right, Seon Ken. Oh, sweet. Yeah, thanks for bringing that up. Thanks for bringing up ACGL. Cool. 20% gain. Congratulations. So as he saw for engineer, with a small knowledge of cybersecurity, I definitely think Crossroad will be big chain future, especially digital warfare. Yeah, I think, so a couple of things in this space of cybersecurity. So it's really important. I agree. But as with any industry, as industries mature, the big software companies are going to have to design and engineer the best security into their software. Microsoft, Alphabet, think of those big software companies. Now, CrowdStrike and a couple of others, they're kind of independent of those software developers, and they may have a place in the future, but I don't think it's going to be as big. The analogy I would make is, you look at any other industry, over time you have fewer players, and the players that remain continue to do more. Alphabet just acquired a cybersecurity company, and their acquisition, $22 billion, is exactly for that they want to be all things to their customer. They want to have cybersecurity. So that's bad news for CrowdStrike, unless they get acquired by a big software company, because CrowdStrike now has to compete against Cisco. I showed you their valuation. They've been around for a long time. They have a lot of relationships. Alphabet, man, that's a tough competitor. I know Microsoft has cybersecurity capabilities. They'll probably want to make theirs better because they don't want to depend on CrowdStrike. Microsoft's got to be really upset that so many of their customers were taken down. It was a bad day for Microsoft, and they didn't do anything other than partner with CrowdStrike. So all those things, I mean, there's just a lot there. It's going to take some time, but if growth stops for CrowdStrike, the revenues stop growing at the rate that they were, that's a problem for the valuation. So you think CELH is a buy now? I like where your head's at. If you really understand their business and see that there's going to be kind of a game-changing event like international expansion, can't argue with that. I think growth investing is about that. If you see something that's going to happen 2-3 years down the road, you can really buy at the right times. Yeah. So I think you're right so your comment that CrowdStrike is going to be a beneficiary of cyber threats. Yes, but so will CrowdStrike's competitors. It's, Palo Alto, you have Fortinet, you have Cisco, you have all these other companies that just got stronger because CrowdStrike just got weaker. There's no way around it. CrowdStrike had a huge outage. So I get the cyber threats are huge and they're really important. I'm not arguing with that fact. I'm just saying that CrowdStrike was priced for perfection. They just proved to be less than perfect. They had a colossal failure yesterday or the day before. And I think they're going to be paying the price for that. And we'll see what that price is. It might be the 11% they went down in one day. I think it's going to be more. And their competitors just got stronger. And the customer just got less interested in CrowdStrike. I think their brand is going to take a huge hit. I don't know how anybody can argue that. It'd be like, remember if Chipotle had food poisoning? Chipotle had food poisoning a couple of times, and it was a big hit on revenue. It was a big hit on profitability, and it cost them a lot of money in the near term. Now, they recovered. We haven't had any food poisoning at, Chipotle in a while, but that's the kind of effect that I think CrowdStrike's going to have. And maybe I'll be surprised and the market doesn't care. It's like, oh no, we don't care. CrowdStrike's going to keep going up. We'll see. I could be wrong. You don't think they'll make that mistake again? Well, I would, again, I hate being like a jerk about this. And I try not to be, but I try to be rational, right? So to develop code and deliver it to customers, you have thousands of people, and those thousands of people are making tens of thousands of decisions to set up the software, get it to market, do it in a way that's going to be near perfect, if not perfect, for your customer. Put a period on that. If they could have a lapse of this magnitude once, the likelihood that organization is going to have more lapses is very high in my mind, because it happened once. If it happens again, this company's going to be destroyed. It's like, oh my God, it happened twice. But I think that, again, if it was just one error and their quality control did not catch this error, I mean, if it was an update, if it was a software update, they should have tested this software update in a multitude of ways, because they know they're going to affect hundreds of millions of PCs. So if they make an error, they just affected hundreds of millions. So if their quality control didn't catch that simple error, I lost a lot of confidence in that organization. I already had a low valuation for them. So let me be transparent about that. I had already shorted the stock because I thought it was overpriced. This just adds one more reason why I'm glad that I shorted the stock. You may be right, Gabriel, and I may be wrong. I'm willing to admit that I could be wrong on this stock. It could go up, but let's see where it goes. Let's see, maybe in a month's time, where it goes. And then next one, CrowdStrike. I think it's to me, it's not a buy. I've gone over it a few times. So yeah, Gabriel, good again, I could be wrong. You could be right. Let's see how it goes out there, but I'll share my, observations and my analysis. And, I learn something new every day, and let's see how it goes. All right. Can you please look into FTNT? So Fortinet. So these guys went up just 6% yesterday. Wow. And these guys have been pretty much not really doing anything over the last couple of years. It's a $44 billion valuation, about $30 billion less than CrowdStrike. So let me do this. So these guys are $3 billion in revenue, $5 billion in revenue. Okay. PE ratio of 38. P ratio of 575. Wow, that's high. All right, so these guys are discounted by 18%, discounted by 24%. I'm sure that's going to be changing. And financials. Okay, so these guys are growing. They're growing quite well. Quarterly, 7%. Okay. Not like crazy growth, but growth. All right. And their valuation is $44 billion. When we look at cash flow, they are at 1.69. I'm going to go 1.7. It's a growing business in a hot space. Multiply that times 3. I get to 51. Okay. And 51 compared to 44. This would be, if I went through the paces, and let's do that now because it got very interesting. Let's compare Fortnite, and then we'll compare it to CrowdStrike. So all right, so here's CrowdStrike, and then I have Palo Alto here. I haven't updated this data, but that'll be very easy to do. And then we'll compare CrowdStrike to Fortinet, and then Palo Alto. Okay, so FTNT. So these guys here, I haven't looked at their balance sheet, but I'm gonna go with a 10 because they're lesser known. So that's fine. All right. So free cash flow was so they cash flow better than CrowdStrike. Now, according to so their growth rate was not as high as Palo Alto, CrowdStrike, excuse me. So I'm going to go with they're going to grow their cash flows by 10% because they're maturing. As they mature, this space is going to stay hot. Okay. Cash on the balance sheet. Let's take a look at that. So they have $3 billion of cash. And then we've got debt, total debt, 992. All right. And then we've got their market cap is 44,680. Shares outstanding, 763 million shares outstanding. 58.48. So I'm showing a 16% premium on Fortinet if you look at their cash flows. Now, a big factor is this 10. Let me look at, so they're, all right, so I'm going to go with like 9.5. What did I use on CrowdStrike? So on CrowdStrike, I use 9. All right, so I use 9. So they're pretty much fairly priced. If you look at cash flow and you discount it 9%, you get to pretty much a fair price on the stock. We look at their earnings per share. So $1.80. And I'm going to go 24. Their growth rate's 10%. Because they're expected to grow much higher than that. So it's fairly priced. Fortinet's fairly priced. In my opinion, that's fairly priced. If we look at Palo Alto, oh, not sure why Google wasn't giving me that number. So 330.89. So Palo Alto, I have, and this is a little bit dated by a month and a half, but I have Palo Alto as being sold at a premium of like 29%. They had a pretty good day yesterday, 2% up. But this space here, it's gotten a lot of attention. It's really important. But boy, you have any errors, you could really see these stocks tumble. So Fortinet didn't really do that much for me because it's fairly priced. I think I had looked at it before. And Palo Alto is priced too high. And I've already shared my comments on CrowdStrike. So thanks for the question there. Can you look at Fiverr? So Fiverr. So I'm rating up what this is all about. Okay, cool. So they're an online company. Cool. Small cap. All right. Small caps are coming back. Revenues 366. They have a PE, so they're profitable in a way. Discounted by 46%. What is going on? 25% down. So, okay, fiber's there. So they're growing. If we look at the trailing 12 months, they are growing good. So they don't have crazy high growth. They're a small business. They don't have a lot of high growth. Okay. $22 balance sheet. They have cash of 489 million. Total debt 462. So they could pay off their debt immediately if they wanted to. And from a cash flow perspective, they have 89 million in free cash flow. So this would calculate at a discount. 11 analysts are saying that it's a buy and it's discounted a lot. Yeah, this would calculate at a discount. So this one looks interesting. Yeah, this one is worthy of more homework on it. I'm gonna do more homework on it, and maybe there'll be a video. So my response to you is it looks good. It looks worthy of a lot of analysis, and I'm going to take a look at it. Gabriel, thanks for tuning in, man. Really appreciate you. Bad Omen, checking in. What do I think about Toyota? So Toyota's good business, and last time I looked at them, they had a very good stock appreciation trend. If you look at their year to date, up 8%. I think they had some issue where they weren't completely honest with one of the regulatory agencies. I think it was California or one of them. So they got in trouble, and then their stock started to tumble. This is, in my opinion, one of the best car companies in the world. It's a very, very good company. It's a big cap. Might be the second most valuable company in the world. Number one is Tesla. This is not a bad investment. It's a good company. Look at their growth rate, and they're massive. Look at this number. This is yen, but even if you convert it, these guys are massive, and they're growing really, really well. So this could be an interesting investment. I would do homework on it. They have a really low PE. I own Ford, and I'm good with Ford right now. So I wouldn't be looking at Toyota, but I think Toyota is a good company. And it actually, Toyota for a while, it was like Ford's beginning to do well. But for a while, Toyota was looking way better than Ford. Because if you saw, and I think I saw Toyota around this range, it was killing it. It was up like 40, 50%. So it's down. It might be a buying opportunity because, hopefully they sort out those, problems they're having with the regulatory agencies, and they can get on with it. And they're going to have earnings. Their cars are really good. Like our family, we own one Toyota, but I don't think there's ever been a time when we didn't own a Toyota. And I just think they make really good cars. So overall, and I think the Japanese economy has really been doing well too. So S Travel is 4K. Coors and Mara are great buy before Trump's election. So he is pro Bitcoin. Okay. So Coors and Mara. So Coors. So Coors Scientific provides digital asset mining. Okay. So these guys are mining Bitcoin. So as the price of Bitcoin goes up, these guys create more revenue. All right. They're losing money right now, which isn't good. PE is 80. All right. Looking at their 5-year chart. Wow. Look at that. So 1 year, 87%. So Bitcoin's been doing well. I think it's, last time I looked at it, it was like 66,000 last time. I looked at it like yesterday. So now it's 67,000 a coin. Okay, cool. So, I mean, that's been going up nicely. Let's look at the 1 year. So we've had a nice recent upward trend for the year, 52%. For the full 12 months, up 126%. So this may be, the case. I've never invested in a company like this. I own Bitcoin and I own Ether. Those are the two coins that I own. That's the smallest portion of my portfolio. I think it's like 4% of my overall portfolio of, I'm going to call it liquid assets. It doesn't include my real estate. So this one here, I mean, if you really know the ins and outs of, I think this is crypto mining, this might be a good investment. I'd look at their growth rate. Their growth rate isn't looking good. I mean, it's down 21% for the revenue. So I'd want to understand, what's going on with that. Why is there, but it's up again. Okay, good. Yeah, you might be on the right track. That this could have a real benefit if Trump gets elected. They're not a big cash flow producing company just yet. And I'm looking at the quarterly, so let's look at the annual. So trailing 12 months, 20 million, right? So even if I multiplied it times, 50, looking at $1 billion valuation. So I still struggle to get to a valuation of this level. But if you understand this better than most, use that information advantage to your favor. Looks like it's a strong buy, according to 6 analysts that have price ranges from $8.50 to $20. So you may be on the right track of a good investment here. But this is more speculative than it is from a fundamental perspective. If I use fundamentals, I can't get to the valuation. But if you understand this, again, if you have an information advantage, use it. So that's how I look at that one. Am I optimistic? Oh yeah, Marathon Digital. This one's, I have heard of this one. Up 38%. And they're down. Okay. So these guys are there. If I look at their cash flow, see, these guys don't produce free cash flow. That's kind of a showstopper for me. That usually tells me this business is going to be around for a long time. I think Marathon may be in growth mode, so they're like, well, we don't care about free cash flow right now. So PE is 10. Wow. How are they this good on their earnings per share, but they produce no free cash flow? Are they having to buy a bunch of GPUs and therefore have to burn all their cash? That might be it. Yep. So good luck with those two. I'm going to stay in my lane. I don't invest in these companies, but I just invest in Bitcoin and Ether, more of a stored value as a hedge against everything else. So good luck with that. Yeah, AMD has been taken out behind the woodshed recently. They're down with the semiconductor industry. I mean, they've had a pretty good drop of 17.6% since the 10th. Over 9 days, they've lost 17.6%. The 1 year, they're up 37%. But they were doing really well from the low point in 2023 to the high point. They were up 125%. But if you look at from that high point to now, they're down 28%. I think the semiconductor space is really overpriced. And I think the whole AI-driven build out of the data center has been overplayed. It's going to begin to really unravel. Not only advanced AMD, but if you look at like TSM had a very good earnings call and their stock price went down. So it's like, wow, man. So they had their earnings and their stock's down big. It's because the prices for semiconductor companies got so high that I don't know what valuations they were using, but now once they use the valuations of, okay, they announced their earnings, everything came in within expectations. People just got scared and got out of TSM. They got out of NVIDIA, out of Broadcom. All those semiconductor stocks are down. So good luck with that. Are you still holding on to Chegg? So I got out of Chegg and I just got back in. I think Chegg has got this crazy chart. If you look at, it doesn't really show it there. Like it's down 70%, but let's look at the monthly. If you look at when it was expected that interest rates were going to drop, it went up 38%. I think a lot of short sellers got squeezed, and that's why it went up 38%. And now it's back down. But I think if you look at Chegg, the valuation is just so dirt cheap. Let me show you what I'm talking about. If Chegg begins to grow their revenue, this stock will triple in value. This is my valuation of Chegg. Okay. If you look at the earnings per share, it's just so undervalued. If you look at their free cash flows, which they generate, it's undervalued. It's undervalued big. And if we look at their compares, they're getting easier and easier. Compares being like, if you compare this quarter versus the quarter of last year, right? So they've been dropping revenue, and it's really because during COVID, kids were sent home. Like, okay, I know you got high school calculus, but go home and learn calculus online on Zoom. And the college students as well were like trying to learn subjects, on Zoom. So they needed assistance. So they boomed during 2020, 2021. You had high growth. And now a lot of those students have graduated, they've moved on, and the demand hasn't been as high, but it hasn't been a collapse of revenue. It's down 6% when they grew their business big, right? So when we look at their quarterly, if this quarterly turns positive, and you see how they've been negative. So if we look at the next quarter that'll close would be June 30th. If they compare it to this quarter, and let's say they came in at 185, this stock's going to fly, at my expectation. So the fundamental support that, hey, this company is unappreciated. If they begin to grow at all, the stock market's going to go crazy over this stock, in my opinion. But look at the price target. It's a sell, but it's unappreciated and it's discounted by 111%. The price target is $6.91 and the stock's $3.20. And if you look at their balance sheet, I think they have more cash than they do debt. They have $390 million in cash, total debt of $616 million. So not quite there, but pretty close. Like they could pay 2/3 of their debt immediately, but they do have good EBITDA. So if we look at their debt to EBITDA, it's a pretty good ratio. Let's find that. Debt to EBITDA, 0.6. They can pay off all their debt in less than a year. So their balance sheet's strong. It's a business that if they figure out, here's the other thing that I'm tracking is Chegg is building an AI app that's going to be for the student. Okay. And if they get that going and they generate some revenue, it's going to be really interesting. They'd probably be acquired by some other bigger company. So there's a lot of things that could drive the Chegg price, and we'll see what happens. But thanks for asking about that. Some meme stocks. Oh, man. So GameStop, man, watch the movie. That was a good movie. What was it called? Like Dumb Money. So that was good. And then Chewy, DJTs, all. Yeah, the whole Roaring Kitty thing. Man, it's fascinating how Roaring Kitty can cause such drastic move in these stocks, but I'm staying away from it because I think it could be more of a distraction for me. I'll just make money on, Meta stock. I'll make money on Uber stock. I'll make money on all my stocks, and I'll let the fun and games up for somebody else. But it has been interesting, and I did enjoy the movie Dumb Money. I thought it was hilarious, as well as the movie on The Big Short. I thought that was a really good movie. So Man, that was a good live stream, everybody. Thanks for bringing it today. I appreciate it. As I close, just a reminder, we have a conference or video conference tomorrow. Let me get to my channel, and then I'll show you where you can go get more information on it. And we're going to get on a video conference and have pretty much a session like we're having here, except we can just talk to one another. It looks like we're going to talk about how to manage your portfolio. That's the number one topic that people want to talk about. So I'm cool covering that. And it's probably going to be, we'll do it each week, and we could just take it on and maybe cover it to some extent. And then each week we can cover a topic or two or three. And we could also look at individual stocks like we did just now and do a deep dive on a couple of stocks, go over how valuation models work, and so forth. So I invite you to attend. If you'd like to attend, check out, give me your email address, and let me get to my email. Here's my email address, victorhinvesting@gmail.com. Send me an email, say, hey, I'd like to attend the video conference, and I will send you an invite, and you can attend. You can participate however you like. You can be a silent participant, or you can, ask questions, and you can be on camera, off camera. It's up to you, and we'll go from there. So everybody, thanks for tuning in. I really appreciate you. And that's all I've got for you today. It was an interesting week, man. We'll see if this stock market continues to go down, and if it continues to get better prices on these awesome companies that we want to be owners on. Good luck out there. And thank you so much for watching my videos. You guys enjoy your weekend.